All right, welcome to the Explainer. Today, we're taking a look at a blueprint that honestly feels like a total cheat code to financial freedom, even though it's sitting right out in the open. Get ready because we are diving deep into the math, the mindset, and the actual mechanics behind what we like to call the $1.49 million formula.
So, what if I told you that becoming a millionaire actually doesn't require a genius stock pick, or some lucky crypto bet, or a crazy side hustle with a flashy logo? Wall Street absolutely loves selling us this narrative that wealth requires insider knowledge, high-stress trading floors, or catching the next big trend right before it explodes. But what if the reality of building a massive portfolio is, well, incredibly boring?
What if it was literally as simple as $1,000 a month? That's it. No drama, no trying to predict the market, no chasing a breakout opportunity. Just one simple drama-free monthly habit. Now, most people don't believe it at first because $1,000 a month sounds pretty small in the grand scheme of $1 million goal. But time has this weird superpower, and if you repeat it long enough, this single habit can quietly turn into $1.49 million.
Let's start with Section 1, the millionaire myth. Let's meet a regular investor named Alex.
See, Alex isn't some financial wizard staring at stock charts all day like they're ancient scrolls. No, Alex just automatically invests $1,000 into an S&P 500 index fund every single month. And this brilliantly illustrates the core philosophy of the S&P 500 strategy. The S&P 500 is essentially just a basket of the 500 biggest companies in America. When you invest in it, you aren't trying to guess which individual company will be the next breakout star. Instead of taking on the massive risk of betting on just one horse, you simply buy the entire racetrack. You're investing in real, tangible businesses that you interact with every single day. We're talking about massive household names. By putting that $1,000 into an S&P 500 index fund, you instantly own a tiny piece of Apple, Microsoft, Amazon, Google, Coca-Cola, Nvidia, the whole shebang. You don't have to time the market or read boring earnings reports because you already own the heavy hitters that drive the American economy. Which brings us to Section 2, the simple 1K strategy, where there are basically no moving parts to break. The reason this strategy functions so effortlessly is the engine actually powering it: compound interest. Think of it like the financial version of a giant snowball rolling downhill. At first, it looks tiny, but as you invest money, it earns returns. Then those returns start earning returns. And then the returns on those returns earn even more returns. It just builds this unstoppable exponential momentum until your little snowball is a full-on financial avalanche. Okay, let's dive into this in Section 3. The magic of compounding, relying on an 8% average return. Let's really lay the numbers out flat over a 30-year period, assuming a historical average annual return of 8%. If you're investing $1,000 every month for 30 years, that is 360 months of consistent action. The math on that is super straightforward. 1,000 times 360 equals $360,000. That means you personally only put in $360,000 of your own hard-earned money over those 3 decades. That is your total out-of-pocket contribution. But here is the absolute jaw-dropper. Your ending balance is right around $1.49 million. So where exactly did that extra $1.1 million even come from? Well, it came from your money acting like a highly productive little employee. The market did part of the work, the returns did part of the work, and the compounding literally did the rest. To really grasp the weight of this, let's contrast how we usually spend $1,000. Think about vanishing lifestyle upgrades, a nicer car lease, eating out constantly, impulse online shopping. None of that is evil, for sure. But that money disappears forever. Now contrast that with redirecting that exact same $1,000 into a growing asset like an S&P 500 fund every single month, rain or shine. One path leaves you with memories and depreciating items. The other literally buys your financial independence. Let's see how this actually plays out in Section 4, the 30-year wealth timeline. Let the decades do the work. Now, quick reality check. That 8% is an average. Some years the market is going to drop significantly, acting like it completely missed its morning coffee. That is totally normal. But if you let the decades do the heavy lifting, here's the timeline. After 10 years, you've put in $120,000 and you have about $183,000. Not bad. By year 15, you've put in $180,000 and sit at $348,000. By year 20, you hit $589,000.
At year 25, you're knocking on the door of $1 million at 932,000. And at year 30, you cross the finish line at $1.49 million. Notice how your money starts doing way more of the heavy lifting as time goes on. Now, what's really interesting about this slide is the sheer explosion of growth at the very end of this table. Just look at the massive jump in your balance between year 20 and year 30. A huge chunk of your wealth is generated in that final decade alone. Why? Because the money you invested way back in year 1 has had decades to grow, and its growth has had time to grow. It's compounding, stacking on top of compounding, and it heavily, heavily favors those who stay in the game the longest. And this brings us to a pretty harsh reality, honestly. The cost of waiting. You hear it all the time, right? Oh, I'll invest when I make more money, or I'll start next year. But waiting costs you the absolute most valuable ingredient in this formula: time. If our protagonist Alex waits until age 35 to start instead of 25, Alex misses out on that explosive final decade of compounding. That single delay is literally the difference between having a decent retirement portfolio and having absolute, unshakable financial freedom. Which leads us perfectly into section 5, 3 rules for success. Basically, how to not break the snowball. To make this strategy practically foolproof, you've got to stick to 3 non-negotiable pillars. Rule 1 is consistency. You invest the exact same amount every month, no overthinking, and 0 emotional decisions. Rule 2 is simplicity. You aren't chasing hot stock tips, you're automatically diversified by owning a broad slice of the market. And rule 3 is patience. This one is absolutely non-negotiable. If you panic and pull your money out when the market dips, you interrupt the entire compounding process. You have to let it breathe. Let's ground this in reality with section 6, find freedom with time. This is the real product. Look, we have to keep it real here. This isn't magic. Things like investment fees and decades of inflation, yeah, they will absolutely take a bite out of your exact purchasing power over 30 years. But the real lesson here isn't about just staring at a cold number on a screen. Consistent investing over decades creates something far more valuable: options. That money becomes a vehicle. It means having the option to retire earlier than planned. It means the ability to help your family out. It means buying freedom with your time so you aren't tied to a desk forever. Ultimately, it means sleeping better at night, knowing you are totally secure. This brings to mind a fantastic perspective. Excitement is loud. Patience is rich. Real wealth is rarely built by some giant, glamorous move that you can brag about at a dinner party. It's built by small, unglamorous, super boring moves repeated long enough in the shadows until they become something enormous and undeniable. Because ultimately, the biggest money mistake you can make isn't picking the wrong stock. It's failing to start. The market rewards patience. Compounding rewards consistency. But above all, time rewards the people who stop waiting. You have the formula, you know the math. So is your day one going to be today, or are you going to keep waiting?